Hey everybody, welcome to the weekly Q&A with Julie. I'm Julie, and I'm here with Justin LaRue. He and his brother, oh my gosh, shoot, I'm forgetting your brother's name.
Jeremy.
Jeremy, thank you so much. Unique spelling. He's got a unique spelling. I was introduced to them from another associate that's here in Kelowna named Patrick, and I met Patrick from a networking event. And so you never know how you're going to meet people. That's how important it is to attend networking events. So if you're not already doing that, let's just start out with a quick tip that you should be getting out there, shaking hands, and meeting people because I met Jeremy first, and he talked me through ways to use auto financing to move you forward in your credit and in your financial goals. And then he introduced me to his brother who's here with us tonight, Justin. And last week we were supposed to meet with Jeremy. He had a last minute uh, family situation come up. So we're hopefully going to be meeting with him next week or at least sometime soon. And in the meantime, we get to talk to Justin. And after my conversation with Justin, he made insurance sound interesting. And that was the first time. That was the first time for me. He understands what real estate investors and business owners and entrepreneurs need when it comes to their insurance needs. And he's also got some strategies when it comes to your registered savings that might also help you reach your financial goals more quickly. So he's out of Edmonton and he is licensed. I'll let him go over all the people that he can help across Canada. I think you're really going to get a lot out of this. I'm going to get rid of my video and I'm going to be in the background if anybody comes into the room or needs to ask questions. And I'm just going to let you take it away. Justin, you just let me know if you need help with anything. And I think you are set up. Yes, you are to share your screen. Great. Take it away,
Awesome.
Justin.
Hey, well, thank you so much, Julie. Appreciate the introduction, and it's a pleasure to be here. I'll share a really quick story, a little bit about myself. Been in the industry, in the financial services field now, closing up on a decade now. It's been absolutely awesome. It's been a pretty cool journey, starting a business and becoming an entrepreneur. Both my wife Amy and I are both fully licensed, and we kind of been working together since the very beginning. Sometimes people ask, why do you do what you do, and what are the things that you really enjoy about it? And there's many reasons for it. One of which is just helping people achieve their financial goals and just really getting a grip on money, understanding money. It can be an overwhelming topic, and in today's day and age, there's so much information out there, right? On the internet, ChatGPT, you talk to friends, to associates, to colleagues. And the problem sometimes with that, with so much, information out there, is oftentimes it's maybe based on someone's opinion, right? And just because maybe something worked for one person, it doesn't always mean it works for everybody, right? So for me, it's really about laying things out for people and really making it make sense, and understanding it in a way that it just clicks, right? Prior to working in this industry, I actually came and worked in the oil and gas industry. Used to be a journeyman tradesperson. And I had what I would consider the golden handcuffs, was making well over six figures, pension benefits. But I wanted more. I've always dreamed of being a business owner, working for myself. And this wasn't necessarily on my radar. It's not like I woke up one day and thought, oh, that's what I'm going to do and be a broker in the financial field. But through connections and one person referring me to another, here we are today, and I would never go back. So, a couple of things to note in terms of our team. So, my wife and I have a team of 45 licensed advisors. And collectively, we're licensed in multiple provinces and territories in Canada. So we're licensed to practice in British Columbia, Yukon, Northwest Territories, Alberta, Saskatchewan, Manitoba, Ontario, New Brunswick, Nova Scotia, and now officially Newfoundland. So we're not quite all provinces and territories, but we're very, very close. And I would say our main hotspots as of today, we do a ton of business in BC, Alberta, and Ontario, with some sprinkles in other provinces there. So, without further ado, excited to dive into things. Now, as I kind of get into this, I understand there's some of these concepts and things I'm going to touch on, are familiar with you. You know about these things, maybe you do and have some of these things in place, pieces of it, and then maybe some of this information is new, and hopefully I provide value today. Of course, you're going to be the judge of that. And so here we go. I'm going to go ahead and share my screen here, and let's really get into things. So the first thing I really want to illustrate is just the power of being a broker. One of the things that I guess is a difference between working with a broker as opposed to maybe working with an advisor that's tied to just one company. You work with an advisor with one company, they're only going to be able to offer you what they have in-house. Not to say that they have bad products, but of course they're limited as to what they can offer, right? So we work with some of the top banking institutions, insurance and investment firms in Canada. This is just a handful of partners and carriers that we work with. Looking at the screen I'm sharing here, my guess is most of you probably are familiar with a lot of these companies. So again, the big idea here is just having access to several companies and really bring the best to our clients, right? Making sure people aren't overpaying on things like insurance, making sure people have great access to awesome investment firms and portfolios and so on and so forth. So really where our process starts is we really want to learn what our clients' ideal financial goals are. Because let's be honest, everyone's a little bit different. Everyone's got different needs and wants. And so once we take that into factor, that's when we get to work and we start designing a program that really aligns with what's important to you. The best part about our services, important to note, is we don't charge our clients anything for our services. So there's no consulting fees or hourly rates if someone wants to meet with me or my team. How we get paid is very similar to, say, a mortgage broker or a home and auto broker, where whichever company we end up using to help a client, that company and carrier pays us and the client does not. Okay. So I don't think any of us have been living under a rock to say that, it's a bit challenging in the climate here for Canada in terms of financings, right? And these are the things that we're committed to working on solving and helping more people getting ahead. Now, on the debt side, we're at an all-time high when it comes to consumer debt, right? A lot of Canadians out there are living paycheck to paycheck, accumulating more and more consumer debt, higher balances on credit cards, lines of credits, things like this. And a big part of that is the cost of living has come up so much, yet people's wages and incomes not so much, right? And of course, that money has to come from somewhere if they want to keep up with lifestyle, vacations, and just plain living, putting food in the fridge, etc. So there are opportunities for us to help clients free up cash flow, maybe find ways to free up some debt and give them some breathing room so they can actually start getting ahead. Now, speaking in the middle here about investing and saving and just building wealth, the unfortunate reality is a lot of Canadians today have no clue how much they actually need for retirement. And I think we can probably agree that that's an important thing to know. If we're going to be working 20, 30, 40 years of our lives, it's important to figure out what is the target, right? And so we really clear the fog for people. We really want to make sure that we remove any uncertainties they may have and help them understand it and realize what's the goal, what's the number, and what's the plan to get there. Now, a lot of clients that come to us already have investments kicking around. If they don't, that's fine. We'll help them too. But it's not uncommon that people have things already in place. But what we found is many times they're not getting as high of a return as they could be. Okay. So again, that's where we come into play is we can really start making some comparisons of portfolios and finding ways to help our clients getting their money working harder so that they can A, retire with more money than originally projected, or two, help them maybe retire sooner. Everyone probably wants that. Now let's talk about insurance, right? Like Julie alluded to, insurance, let's be honest, a bit of a boring topic for the most part as a generality, right? It's not sexy, it's not fun or exciting like talking about maybe rental properties or getting into real estate or building wealth or, all these different things. But I will say getting the right insurance can and is the one of the most important purchases you can ever make in your life. If I was to ask you, what's the biggest asset that you have? Most people would tell me it's my house, it's my properties, it's my truck, it's my boat, it's my RV. Actually, the reality is the number one asset you have is you. And really, it's your ability to earn an income. It's your income that's such a big asset. Whether that's income from any rental properties that you have, income from your occupation, your business, your job, your career, etc. Right? So the unfortunate reality is a lot of Canadians today would be absolutely financially devastated, in fact, crippled, if the main breadwinner was to pass away or suffer from a critical illness or get into a major accident and as a result get disabled. So really what we want to do is get proper protection in place, giving peace of mind. Now, here's the thing that's important to note. Insurance kind of gets a bit of a bad rep, right? A lot of puts a bit of a sour taste in people's mouths, and I can't blame them for it, especially when it comes to getting things like maybe you've heard of something like mortgage insurance. Maybe you've heard about different insurances that are placed on credit cards like Balance Protector or different insurances on vehicle RV boat loans or ATV loans, right? The problem with those insurances is the chances of them ever to get paid out upon claim are very, very low. And so, of course, if you're paying for something, you would hope that it would pay out. And when it doesn't, well, we're pretty upset about that. Can't blame anybody for thinking that, right? So that's where we put policies in place that are upfront underwritten, making sure that we qualify upfront. Therefore, if we do put in a claim, we can actually rely and count on that to pay out. Okay. Now let's talk a little bit about building wealth in traditional investments, whether that's RRSPs, tax-free savings accounts, non-registered accounts, you name it. I really want to just start with talking about something called the Rule of 72. Now, this is a very powerful formula. It's quite simple on how it works. You might have heard about this. Maybe this is new to you, but it's simple. You take the number 72 divided by the interest rate you're earning on your investments. Okay. The answer is simply going to tell you when you divide 72 divided by your interest rate, the answer is going to tell you how many years is it going to take for your money to double. Okay. So let's say, for an example, someone had $50,000 in an RSP. Okay. They were contributing $200 a month into this RRSP. They did that for 30 years, but they were averaging a 2% interest rate. Well, if we apply our compounding effect to this, the end result is they'll have about $188,000, better than nothing. But what if that same individual had that 50,000? They were saving 200 a month, same timeline, but now they were averaging an 8% interest rate and rate of return long term. They're ending up with nearly $600,000 more in this situation, right? So when it comes to saving money and just investing in general, I believe there's really three key components to it. The first two are pretty obvious that you're going to know about already that you just know. Number one is willing to save money, right? Of course, we got to start from somewhere. We got to start saving money, whether that's $100 a month, 200, 500, 1,000, whatever a person can start with. Maybe it's $50 a month, but we got to start somewhere. The second thing is timeline, right? The sooner we start, the earlier, the more timeline and runway we have, obviously, the better, allowing that compounding effect to take place. The third thing, though, this is the third component is where a lot of people miss the boat is they're not putting their money to work. They're not investing it wisely, and they're not getting as good of a return as they could be. Again, circling back, that's where we do those comparisons. So this next part I'm going to cover is quite busy, but I just want to break things down left to right, and we'll just really make sure that hopefully you get a better understanding on the services I provide, but more further and importantly than that, the education behind these different offerings. So talk about mortgages, right? Um, Especially in today's interest rate climates, but interest rates are higher than what they were during, let's say, 2020 and thick of COVID times, right? And so at the time of this recording, mortgage rates are right in the ballpark of between, let's say, 4 to 4.5%, as opposed to back in 2020. It wasn't uncommon that I was helping clients getting 1.7, 1.82% interest. And so if your mortgage for your primary and or rental properties haven't come up for renewal, they likely will be. And that could be a concern to many people because if your interest rate is going to be going up upon renewal, that means the payment will as well in many cases. So that's where I really emphasize on, instead of just re-signing blindly with your existing lender, make sure you actually play the hardball game. Shop around. Work with a broker. Work with someone that can actually has access to multiple lenders, and make sure you get a competitive rate. Yes, I have mortgage providers that I work with that I have access for my clients, but I want to note that Julie has a phenomenal broker by the name of Craig that she trusts, she uses. So again, highly recommend using someone like him, and or someone that can really just work for you to help you out. A couple of quick things I'll cover. If you're a parent, or you plan to have a family of your own, I can help people with the kids' futures, right? RESPs is a very traditional program to save for post-secondary education. There's government grants involved. It can be a good play for sure. One thing, my wife and I actually, we've got a just about a 1-year-old son, our first child. And we think a lot about how can we really set up our kids for their futures, right? And just being business owners, we've realized that maybe one day they might not want to go to school. Maybe they want to start a business. Maybe they want to take over our business one day, right? But what about helping our kids out in a different way than just school, right? RESPs are great, but they're limited to post-secondary, and that's it. What about helping out the next generation with things like a down payment on their first property? What about helping them out pay for things like a wedding, right? Just big ticket items that most of us adults go through in our lives. So a great alternative to the RESP, or even something as a secondary complement plan, is what's called a permanent cash value life policy. I absolutely love setting this up for kids with their parents, because it really checks off multiple boxes. Number one, it's very low cost of insurance, insuring a child. Number two is it locks in their insurability, meaning that they're young, they're healthy, hopefully. Well, at least they can lock in that coverage, and they get to keep that coverage for the rest of their life, well into their adult years. The most important part, though, is these programs accumulate a cash value. And upon time of them becoming a young adult, the parent can help them access that cash value for all those things I've mentioned earlier. Okay. All right, let's talk about first home buyers. This is very exciting. There's something called the FHSA, First Home Savings Account. This account's been introduced to us in Canada since 2023. It's a phenomenal program. So if this applies to where you haven't yet purchased a home, you would like to, this is a great plan to get into. If you know someone that actually wants to, maybe would like to buy a house, talk to them about this. Okay. It's just like the name suggests, to look at saving money to buy your first house. That's what the account's designed for. Now, a couple big things to note. Number one, you receive a tax deduction upon any contribution you make inside of this account, which is awesome. That's a big, big deal. The money that gets accumulated there grows tax free. But the biggest part is it's accessed 100% tax free upon purchasing a first home. Now, the annual limit is $8,000 per year per person, and the lifetime limit is $40,000 now. Okay. One thing that's very important to note, though, always recommend people starting these much sooner rather than later. Qualifying age is 18. Now, when it comes to these, the contribution room only carries forward from 1 year to the next, starting from the year that you physically opened the account, right? So I'm in a phase in my career where I've got a lot of second and third generation clients, meaning I got some clients, say, in their 50s and 60s, and they've got, young adult children, 18, 19, 20, and they're sending their kids to me to set up some programs. So I always set them up with a first home savings account, even if they don't have a whole lot of money to really save for a house. Maybe we put $100 in that account, leave it as is for now, but then they start getting that contribution room that starts carrying forward year after year. And then once they maybe got more money to put aside to save, they got that contribution room available to them. Okay. Another scenario that might actually trigger your qualifications to set up a first home savings account is, let's say you were a homeowner in the prior years, but you've since sold your primary property or any house that you have on title, and you've rented for the last 4 years. If you've rented for the last 4 years, you could requalify for the first home savings account. couple other accounts that very much so can and could apply to you is the RRSP and the TFSA. So register retirement savings plans, tax-free savings account. Now, both of these have some similarities to them in the way that what you invest your money inside of these accounts. What I mean by that is you can invest in things like stocks, bonds, mutual funds, GICs, segregated funds. These are things that will help you grow your money inside of these accounts. So the first thing I take a look at whether someone already has these in place or they don't, but they'd like to explore those options. We look at, can we get your money working harder than what it's doing right now? Oftentimes the answer is yes. Second thing is really understanding tax treatment and taxation between these two accounts. Okay. The RSP, as many of you know, you receive that same tax deduction upon contribution. It's tax deferred as it accumulates interest. But the big thing is, of course, it's fully taxable upon withdrawal. So sometimes people ask, Justin, when does it even make sense to have an RSP? If I'm going to be paying all these taxes upon withdrawal, why would I have one? Two scenarios, I believe it does make sense. Say you work for an employer that has a group matching RSP. That's free money from your employer. Take advantage of that. Okay. The second scenario where it could possibly make sense is if you're in a higher earning income tax bracket and maybe you're anticipating that you're going to maybe owe taxes come your tax filing. Well, maybe if you have extra cash to deposit in an RSP to just break even or offset that tax bill, RSPs could have their place. Beyond that, though, I highly, highly recommend the tax-free savings account. Although you're not going to get that tax deduction up front, the money that's deposited in that TFSA will grow tax-free, and most importantly, is fully accessed tax-free. Okay. So say as an example, you had $1 million in an RSP come retirement. Well, let's say during retirement, you averaged out a 30% tax bracket, right? So by that point, you're in your retirement, in the course of retirement, you might be end up paying about $300,000 in taxes, netting 700K in your through your retirement, as opposed to TFSA, $1 million in there, all of that goes straight to you tax free. Now, the good news is more and more people are starting to have the TFSA, but the problem is often just sitting at the bank and it's not getting a whole lot of interest. So that's where we can help our clients really taking the next level of getting a better return on their TFSAs and growing that. Okay. The unique thing about what we're licensed in our team for as well is a segregated fund investment, held that in an RSP and a TFSA. So it's very similar to a mutual fund in the sense that we have portfolios, we have billion-dollar fund managers that we have access to, lots of great investment firms like Fidelity, BlackRock, you name it. We've got them, we've got most of them on deck. But the big thing about segregated fund investments is that you actually get to choose a beneficiary. Now, I know you can do this with a mutual fund or even a self-directed account through managing your own stocks. But the problem is by law, if you were to pass away, those types of investments have to go through probate and proceed to your estate. Now, probate is a process that costs money and it takes time. After the fact, your heirs receive the rest, remaining balance. With segregated investments, well, here's what we do with segregated funds is you got that designated beneficiary. There's an insurance wrapper with that investment component. And by putting it into something like this, if you pass away, you can actually get up to 100% death benefit guarantee, meaning that all of that can actually be going to your proceeds of your beneficiaries. Number one, it bypasses probate. So bypasses the estate, goes straight to your beneficiaries. So they don't take a haircut from probate, but also it's got that downside protection from the markets. So say you had 1 million investments in total, unfortunate happened and passed away. Well, let's say the market took a bit of a dip during that time. The valuation of those investments, maybe they're worth $80,000 at market value. Well, if you had that $1 million initially invested, that $1 million would pay out to your beneficiaries, even though the market value is 800,000. Okay, so that's huge. That's a really big deal when it comes to estate planning and just things to think about. Okay. Now let's talk about insurance, taking a bit of a deeper dive. Okay. I'll talk about life insurance more in a minute. I'll skip over that, but let's talk about critical illness. Really, that's for you. God forbid you were to get a diagnosis, cancer, stroke, heart attack. A lot of the carriers that we use and have covers up to 25 different conditions, all the way from multiple sclerosis, to leukemia, everything, a lot of different things you could think about, blindness, aortic surgery, all kinds of different things. It's designed to give you a lump sum tax-free payout and really relieve you from financial stress during a really difficult time with your health, right? And it's things that you could continue to float your mortgage payments. Maybe you've got multiple mortgages, multiple properties. If you're not working, that might get challenging. But on top of that is paying for healthcare, right? If you want to get private treatment, you can get better. Let's say you don't end up using all of that payout for expenses. You can maybe buy a rental property with that money, right? You can maybe reinvest that money, you can do whatever you want. Okay. So it's to really insulate your assets during a very difficult time with health. Okay. Disability, very similar idea where again, quite simple. You get injured, can't work and do your main occupation and your duties that come with that. It's a monthly tax-free benefit that comes in. We design these policies that match and help compensate from your income that was lost, as well as your overall expenses per month. And again, it's designed to give you that financial relief as you're hopefully recovering and maybe hopefully getting back to working. Okay. Now, let's talk about life insurance a little bit deeper. Okay. Again, as I mentioned, life insurance really just provides that tax-free payout to your chosen beneficiaries. It's meant to cover lots of different things. Okay. Number one is debts, lines of credits, vehicle loans, credit cards. Big thing is mortgages. I'm going to talk about that more here in a minute. That applies to maybe yourself as an investor, acquiring properties over the years, okay? Living expenses, funeral costs, and future needs for your family, okay? So here's the thing. Even if you're acquiring rental properties, we can all agree it's going to be an appreciating asset. And the idea is to have it as a cash flowing property and an asset that, doesn't cost you money, it makes you money, right? But nonetheless, if we're tying a mortgage to that property, that's a liability. The mortgage is a liability. So wouldn't it be great that you acquire one, two, three, 5, 10, 20, 50 properties over the course of your life? Could you imagine having some life insurance in place where, God forbid, something happened to you in the short term, in the medium term, in the long term, that when that happens, there's a tax-free cash injection to your beneficiaries where they can go on and pay off all of those properties. And then what happens? Those properties are a 100% cash flowing asset. That is huge, ladies and gentlemen. Okay. So let's talk about types of life insurance. There's two types: term insurance and permanent. Start with term life insurance. Kind of think about renting. Okay. You could take out a policy for a number of years. The most standard in the industry is 10, 20, or 30-year policies. One thing I really want to note to all of you is with two of my carriers, we can actually build a custom term policy. So let's say, as an example, you only want life insurance to cover one particular mortgage. Say you've got, I don't know, 14 years left on a mortgage based on amortization. I can custom build a policy that's good for 14 years and the exact amount of coverage that we're looking to get you protected on for that loan. Okay. The good thing about term policies is that premiums are going to be cheaper up front. Okay. Now, typically, of course, after that policy term is up, you will get the opportunity to renew that term. The downside is, though, is the policy premium, the premiums are going to increase upon renewal. Why? Because you're that much older. Okay. Now, you can convert term policies to permanent at any time. So that's a good thing. Okay. Of course, the minute that you convert it to permanent, the premium cost will be reflective upon the age of when you do that conversion. And of course, if you don't pay the premiums, you lose the coverage, just like vehicle insurance or anything else. Okay. Now, let's talk about permanent life insurance. It's just like kind of owning properties, right? It's something that you can keep forever. Now, with that, of course, there's going to be a bit of a higher premium up front. But really, how it works though is that the premium gets to stay the same if you want it to for the course of your life. Okay. But what's really interesting about these policies is the premium is broken up into two ways. Number one, part of the premium every month goes towards to service the cost of that insurance of your coverage. The other amount, though, goes inside of an investment component inside of the policy. So, what's awesome about this allows you to start build up a cash value within the policy. And what we typically set it up is that at a certain age, we have your policy considered paid up, meaning that you no longer have to pay any premiums into that and you get to keep the policy forever. Okay. There's also opportunities to maybe overfund a policy more aggressively. This would typically take place once you've maybe, you've got some rental properties or maybe not, but you've got like tax-free savings accounts that are filled up and maxed out, maybe RSPs as well. We can really start getting more aggressive of contributing more in a cash value policy. And in fact, use that cash value in the medium or the long term to complement your earning sources. Okay. So hopefully that helps. Now let's talk about amount of life insurance coverage that you should take a look at getting. Okay. I use a method called the dime method. Okay. There's many different ways to calculate coverage amount, but this is what we really specialize in is we take a look at debt, income, replacement, mortgage, balance, and final expenses. Okay. So the debt basically as an example, say someone has a total debt of 50,000. That might be, balance on a vehicle loan, credit card, a line of credit. Let's say they had an annual income of $100,000. We have a 5-year multiplier factor here. So we want to help multiply that replacement of income because, again, if someone passes away and they maybe have a salary job, not a business, well, that income dries up, right? So we want to help replace that income if you have a family and dependents. Other thing is mortgage, right? Again, say this individual has a mortgage balance of 400,000 and then final expenses, $20,000 cover for a funeral, time off work, maybe some flights, accommodations for family and relatives. Okay. So in this situation, an insurable need for this individual would be about $1 million of life insurance. 500 grand can be used to pay off all the debts, and another 500 grand can be used as income replacement. The surviving person could use this money to maybe invest it in, some of the things I mentioned, TFSAs, RSPs, and just live off that just the interest of that, which cash flow $2,500 a month, or they could use that other 500,000 to buy one or multiple investment in real estate properties and cash flow those assets. Okay. So hopefully that was helpful on that front. Now, just to kind of switch gears with everyone, I'm really going to talk about and speak to those who are business owners and that are actually incorporated. Okay. And the last several years, I've really taken a lot of interest to servicing those who are incorporated and business owners as well. I found that there's been a bit of a hole in the market for professionals that really do and cater to business owners and help them. Okay, here's a couple of things that I've seen over the years and some pain points that business owners face. Okay, even though someone that has a business and corporation, maybe the business is bringing in hundreds of thousands a year, if not millions and millions a year in revenue. Typically, it's not uncommon that their shareholder, the business owner, pays themselves a wage out of the company that's relatively low, whether that they pay themselves in a fashion of dividends or in salaries or a mix of both. Usually, it's a fairly low income out of the company. And we could probably both guess why that is. You got it as to stay a little bit in a lower tax bracket. But what can happen as a result of that is their personal investments and savings can suffer as a result. Okay. The other main common pain point that I see is talking about succession planning. What's your plan with your business? Is your business, is it your plan one day to maybe make an exit and sell your company? Is it maybe your plan and hope to pass your company on to maybe the next generation, to your children? Although all those things are great, we need to make sure that we build and hedge against some risks. Let's start with the idea of maybe hopefully selling your business, right? I'll give an example. I was working with a client about a year ago that owns a fleet of semi trucks. He owns about 15 different semis, has drivers in there. They haul fuel and heavy crude oil. Okay. And, when I asked him, what's your exit? What's your plan? And his idea is he wanted to sell it eventually. Like, okay, well, let's think about this. Oftentimes, sometimes you can't find a qualified buyer that will want to purchase your company. Or they might find a buyer, but they might not want to give you what you think your company is worth, right? So a lot of times, if people want to make an exit, oftentimes business owners rely on that to really get them set up for retirement, right? But what happens if you don't get the dollar you're looking for? Well, that really risks you with your retirement planning. On the other hand, let's say someone wants to pass on their business and company to the next generation. Well, oftentimes they maybe want to help out their kids and not sell the business for full market value. Maybe they want to help them out to do that. But if they help them out and they take a big haircut on what the company is really worth, again, that could bring in some issues of them not having what they really need for retirement, right? So this is really my flagship product when it comes to business owners in this regard is setting up what's called a corporate life insurance tax shelter. Okay. So basically the idea is it's to take some retained earnings within the company. What's retained earnings? Well, simply put, whatever revenue your business is bringing in monthly or annually, you subtract all of your overhead. Okay, everything. I'm talking payroll, including your own wages, insurance, financing, any sort of operational cost to run that business. Whatever is left over, that's your net profits, or also known as your retained earnings. So, what we do is we take a small percentage of those retained earnings and we help a business owner put up a corporately owned and funded permanent cash value life insurance policy. The idea, it's less to get the life insurance. It's more to use this as a vehicle to grow wealth within the corporation in a very, very tax efficient manner. Okay. Yes, you have to still pay taxes at a corporate level. It's a bit of a misconception. Some advisors say this, it is incorrect. Some people think this, it's incorrect. They think that you can actually claim and write off the premiums and contributions in these permanent policies. That's not true. You have to pay taxes at the corporate level, but you're still winning because if you keep that money in your corporation, you're at a far lower tax bracket than if you were to pay yourself dividends. So then you pay corporate taxes, pay personal income tax, and then you fund money in something like this. By that end of that, you might have taken a 40 to 50% haircut in taxation. As opposed to leaving it that money in the company, you pay way less tax. But the big part too is once that money lands in that corporate policy, it grows completely tax sheltered, which the nice thing about that, you avoid capital gains taxes. That's a major, major doozy. Okay. So simply put, here's the kind of idea. The idea is to set up a program like this where you're funding money inside of this corporate policy for a period and number of years. And then once you have a significant cash value, 250,000, 500,000, several millions dollars, depending on the program and the size and contributions, the idea is to do a couple of things. I have it illustrated for retirement here. Of course, that would be one of the major reasons that people use it for. But another thing that a person can use this is what's called an IFA, an immediate financing agreement. So, say in the next 5 to 10 years, you have, I don't know, $500,000 built up in cash inside of this. The big thing is you can leverage this policy. So it means that you can leverage and borrow against the actual cash value of this policy and take out a loan against it. And then you can use that loan, which is tax-free dollars, to actually go ahead and acquire other assets, whether that's, expanding your business, maybe putting up a building, expanding your fleet of vehicles, Maybe it's to purchase more properties, right? There's lots of different things that a person can do with that. Okay. There are multiple ways to access the cash value. The first thing that I covered there was the collateral loan strategy, where you can go to a third party lender in Canada here. There's two main lenders that are awesome for this. Number one is Manulife. The second one is Equitable Bank. Now, you could actually go ahead and leverage upwards of 90% loan to cash value on that regard. The second way is you could just access the cash kind of like an ATM and pulling money out of that policy. Now, with that, if you go to withdraw money out of that policy, well, you're going to pay capital gains tax upon withdrawal. And then once that money lands in your business account, your corporate account, then if you want to pay yourself, you got to claim some dividends, which would trigger personal income tax. The third strategy is a policy loan strategy, where similar to the first way, you can borrow against the cash value, but the lender instead is the insurance company that you own your policy with. And again, they can actually loan you up to 90% in most cases of your loan to cash value. Okay. So as I'm just going to wind down here, there's two main types of permanent life insurance. Now, this is where it can apply to both personal and corporate. Okay. There's universal life policies and there's whole life policies. Now, both of them are permanent, both of them build cash value, but there's some important differences to understand in both of these. The first is the premiums, the contributions, right? Again, premiums, part of it goes to the insurance costs. A big part of it is going to go to the investment component. With universal life, very flexible. You can easily increase contributions, decrease contributions if maybe business and times get a little bit slower. You can make lump sums. So you have a really good quarter, you can put bigger contributions and lump sums. Or if things get really, really scary and slow in business, you can actually, in fact, stop the contributions for a period of time, depending on how much cash you have inside of there to sustain itself. Whole life, quite similar, but just less flexible. Okay. You have flexibility in terms of increases, decreases, lump sums, and stops. It's just a little bit less flexible. Okay. Here's the big part of understanding the difference. How does your money actually grow inside of these programs, inside of these policies? With a universal life, you get to choose from a variety of investment funds that are actually in the market. Okay. Now, our portfolio, we typically go with a 5 equity fund portfolio. We've got Canadian stocks, global stocks, US stocks, and typically our long-term return average is 10%. So very, very strong. Okay. But that doesn't go without market fluctuations, ups and downs of the market over the years. Okay. With whole life on the other side, this is where it can be very attractive to a lot of investors, where you actually don't have your money invested directly in the market. How you earn interest and grow the actual investment component is you actually receive dividends from the insurance company. Okay. The average dividend scale, pretty much with any whole life provider that I use and the best that we have access in Canada, is right around that 6 to 6.4% annually. So, although it might not be a 10% average long term like the universal life, you're kind of insulated from market downturns, right? Even if the market doesn't do so good for 6 months, 9 months, 12-month period, you're still going to receive your dividend, which can be very attractive to people. Okay. Cost of insurance is relatively the same, but traditionally universal life can be a little bit lower, whole life a little bit higher, but not too bad of a difference between the two. Now, the big thing is leveraging these policies. With a universal life policy, and one thing to note is if you want to do that collateral loan strategy, okay, and you work with a third party lender to get a loan against the cash value of your policy, they're not going to go out and just lend you 90% loan to cash value if all of your investments are positioned in equities in that fund. Okay. What they're going to want you to do is move it in a fixed income portfolio. So we've got money market funds and we've got a smooth return fund that averages or actually has a guaranteed 3.5%. And in that case, you can actually do the full 90% if it's positioned in a fixed income asset. Now, an attractive part on the whole life side is due to consistent dividends and not being directly invested in the market. Well, a lender is actually willing to lend you that 90% right out of the gate due to that consistent dividend. And of course, you're still receiving that 6 and change% dividend annually, even leveraging it, right? So to summarize this, no, I went over a lot there. Universal life, who's it for? Someone wants to build a very significant long-term accumulation of wealth, but they really like the idea of that flexibility along the way of contributions, deposits, increases, decreases, and they're just okay with the market fluctuation along the way. Whose whole life more designed for? Someone who wants to borrow maybe money sooner, maybe in like 5, 10, 15 years' time. But also they just really are feeling more comfortable knowing that they might not end up with quite as much cash value, still significant amounts, but getting that 6% and change dividend, they can sleep at night a little bit better. Okay. So I went through a lot of information today, that's for sure. Hopefully, this was helpful. I'm just going to leave you with some contact information. At the top left, this is my personal mobile number, 780-520-1945. You're welcome to text me, give me a phone call. My email is displayed over here, and you're very much so welcome to follow me on Instagram at Justin LaRue Official. So with that, I hope this was valuable for all of you. And again, any questions, any things you want to reach out to, always happy to help you out.
Want to see all the notes I took? Like so many notes, you can hardly tell. It's pages and pages of notes.
Wow, that's great. Hopefully this was okay.
Well, it's just so great to do things like this because you can never learn too much about your finances and how to prepare for the future, no matter where you're at. I mean, I'm 51. I still think I'll live a long time, but there's no reason why I shouldn't get some of these things in place. We have insurances in place, and I will just be fully transparent. We haven't paid that great attention to it, even though we know should something happen to us, our kids are going to be looked after to a certain extent. And now they're adults, so mostly adults, so our circumstances are changing and evolving. And a big thing that caught my ear as we were talking before, and I mentioned this, Justin, is that mortgage insurance that so many lenders try to get you to buy. And it just makes way more sense to get into a life insurance policy instead of that, because as you mentioned, the mortgage insurance from the lender is typically much more weighted to the lender. And you
Correct.
really want to have a close look at that.
Yeah.
That's
Yeah.
one thing. If and everybody can take this away because a lot of them are real estate investors. That's one thing. Check it out. See if you're paying that mortgage insurance. Some people have been paying it for years and years and years, and they don't even remember doing that. And sometimes it's just like a really easy checkbox. You know what I mean?
Yeah, actually, if I could comment on that, Julie, I appreciate you bringing that up. And I touched on it a little bit, but you're right. I remember signing off and working on doing mortgage work for our own properties and such. And it's such a quick and easy conversation. The mortgage provider, of course, they're doing their job, right?
Of
But it's
course.
just the way that the system is. And ultimately, they just say, hey, do you want to get some protection on this mortgage? And then they just give you a quick spiel about, if something happens to you, this can protect the payout and pay out your mortgage, right? What's really crazy about this, though, is it's what's called a post-claim underwritten policy. What that means is that they don't actually look at all of your health and your history up front. They'll actually only do that due diligence work once a claim is made, once the damage is done. So that's where, again, there's a very low chance of that paying out. But here's the crazy part, okay? That premium you pay for mortgage insurance stays the same over the years. Yet, technically, you're getting less and less coverage because over the years, we're paying down these mortgages, aren't we?
Mm-hmm.
Therefore, that if it does get paid out, that balance is only going to cover whatever's owing on the mortgage, right? And it doesn't cover anything else. No funerals, no vehicle loans, no income replacement, nothing else, right? So I'm glad you brought that up.
Yeah, yeah, absolutely. So many other things too. So, folks, if you have any questions, reach out to Justin, and he'll help you in the direction that you need to go. Um, Again, Justin, thank you for being here. I know that people are going to get a lot out of this, and I'll make sure that as we send this recording out, that I'll include all of your contact details as well. So, anything else that you'd like to mention before we hop off tonight?
Just going to say thanks again for having me, Julie. It's been an absolute pleasure, and yeah, look forward to helping anybody that we can.
My pleasure too. I'm so glad that we connected. All right, everybody, we'll see you at the next Q&A.